Hello. Today we are discussing socially responsible investing, commonly referred to as sustainable or socially conscious investing. It is a business practice of supporting companies and organizations that are evolving to adjust to the current environmental and societal trends. This is done in three ways. Positive screening involves investing into companies that are making worthwhile contributions to society. Negative screening is the refusal to invest in companies that are inflicting a harmful impact on the world. Shareholder activism refers to the pressure exacted by shareholders to force a company to enact ethical policies or sustainable practices. The role in the past. Socially responsible investing is a long-standing trend that involves integrating social, environmental, and political governments into investment. Evidence of this can be found in the anti-slavery movement of the Quakers. More recently, it can be found during the apartheid era, but the most famous example, of course, is the apartheid. The crucial moment in the history of social responsible investing played the ending of a biased structure of the apartheid administration in South Africa. Then stockholders, from common people up to churches, universities, cities, and even states, withdrew their money from corporations which were operating in South Africa, thus pressuring the white minority government, leading eventually into the economic unpredictability that subsidized the subsequent failure of the government. The current situation. Socially responsible investing has transformed from a niche movement into a mainstream idea in response to the overwhelming evidence of global warming and ongoing socio-economic difficulties. This this ongoing attention from the people is putting pressure on large companies to endorse ethical and sustainable practices or to associate and support brands associated with those actions. To illustrate, recently, Dutch banks such as ING and ABN AMRO had to pull out of a very profitable US pipeline project due to the ongoing pressure from their populace. Companies must concede to this pressure, not necessarily out of financial gain, but due to the possible financial loss. This marks a paradigm shift in the business world. To conclude, as technology advances, businesses understand that their activities cannot be obscured from public perception. If irresponsible patterns of behavior emerge, companies risk ruin brand perception, which could take decades to recover, or not recover at all. Looking at you, BP. And consequently, companies have been enacting responsible policies to position themselves positively in the eyes of the people. To look at it from another view, firms are limiting their negative conduct, fearing loss of public support, strategic alliances, and market share. Whatever the motives of the companies may be, in the end, value is added into the world, and a positive spillover effect is had on the rest of society.